Okay, so great. Everybody, I'm going to go ahead and kick it off here. Yeah, like I mentioned, we aren't going to have Greg on for this call today. Unfortunately, he's run into the travel issues that plagued the entire country over these past few days here. So we'll miss him, but we'll make sure we're doing him justice here. And in fact, we have another CRA partner here, Marcus Williamson, who's a really great mind who we've been working a lot with, and was a very crucial part to building this template out and getting it really operating in a way that we've seen people using day in and day out. So yeah, really excited for that. So I'll go ahead and introduce Marcus here, and then Alisha. Marcus, like I mentioned, partner at CRI. He has about 15 years of experience in just the accounting industry in general, and has really honed in on how to ultimately make his consulting for his clients, just whatever the industry may be, really, really strong. And I think that that's what we've really seen in partnership with CRA, and in particular, being able to tap into that and build the template that you've seen before, and what we'll be able to dive in today. I think a lot of that comes from this place that Marcus was able to build up, and I think that you'll see a lot of that in action. So excited for Marcus to be able to go through that. From our end over here at LiveFlow, we have Alisha joining the call. If you're a LiveFlow customer, you're very familiar with Alisha. She is our absolute modeling spreadsheet LiveFlow expert. So, when it comes to building some crazy complex formula or model or dashboard or template or whatever it may be, Alicia's the person for it, and she's an absolute expert in all of this. So with that, obviously, she had a massive hand in building this template and then making it what it is today. So yeah, really excited to introduce both Alisha and Marcus. With that, Marcus, I will go ahead and hand off the reins to you here and let you share your presentation.
Thank you, Michael. Appreciate that very kind introduction, and glad all of you have joined today. We're really excited to kind of dive more into the model. And I think last time when we got together, it was really just kind of sample data that we use on, sales calls, different things, just to give some flavor of, what does the model look like? What are some metrics? But it wasn't real data. And so today, what we've actually done is, this is one of my own clients. We've taken the data in here, blacked out the identifying information, but this is real world, how a small business operates and runs, what the results actually were over the last 3 years that we're looking at right here. Now, to give you some context, so this company is a consumer products manufacturer. So when you're looking at that, you say, hey, they're retail, they have cost of goods, they have labor, they have marketing, a lot of different things going on. They're also in a space that was really impacted by COVID, in that they boomed. And you can kind of see the numbers here. They had a really rapid growth. And on the downside, they saw a little bit of a contraction as, we saw return to office, things like that. And so we'll look through some of the trends that we see in the data. I'm going to start at a little bit of a higher level and dive in on some of our really key concepts that Alisha and I worked together to make sure that the model really did reflect. And I'll give you some context on what we're seeing now, and anything else I feel might be relevant. As Michael mentioned, please, if you have questions, throw them in the chat, throw them in the Q&A section. We want this to be valuable for you. We want to get everything you need answered. And then if you have any questions after the fact, feel free to reach out to one of us, and we'll be happy to follow up. So this view, as you guys know, we call it the summary view. And so we're going to be mainly focusing on these rolling 12 periods, which happen to line up to a calendar end because we're looking at the end of the year. So when we're looking at this first model, first time we look at a model for a client, I really start focusing in on what are the overarching trends that I see in gross margin. What are the overarching trends I see in our direct labor efficiency? What are the overall trends that I'm seeing in net operating profitability, to kind of start building the narrative of how is this company performing? Out of all of that, I'll say probably the most important information that I need to be able to gather is how efficient are our companies with their labor. If you were with us last time, you've heard Greg talk, labor efficiency is really our hallmark concept. And I'll put it out there that if your labor efficiency as a company is not in balance, your profitability will never be in balance. And by that, I mean, we have a golden rule. Number one, for every dollar of labor you pay out, you need to get $2 of gross margin. It's hard and fast. We've seen it across every industry we work with, every client we work with. If you're able to achieve that metric, you're going to be profitable, assuming you don't have a spending problem. But most small businesses don't, because the problems facing most small businesses is, hey, how do I get production? How do I leverage the expenses that I have? So when we start looking at this client, my eyes immediately come down here to our direct labor efficiency. And so if you'll remember, direct labor efficiency, we're measuring how many gross margin dollars we're generating for every dollar of direct labor that we pay out. And so if you follow this progression, 2 years ago, this company was making just under $7 of margin for every dollar of direct labor. It's pretty good. Got a little less efficient in 22, and it seems we got a little more efficient in 23. And so it's an interesting trend that you really have to take a step back and look at the bigger picture of what could be going on in this. And we'll dive into that here in just a minute. Let's spend a little bit of time talking about what is direct labor. I don't think we really got specific on that. So, a lot of people, maybe you're a business owner, you wear 14 different hats in your business, you're doing sales, marketing, operations. Your employees are probably the same way. And so a lot of people have a tough time determining, hey, who goes where in your philosophy. So our general thinking is if you spend 30 to 40% or more of your time doing revenue producing activities, you're direct labor. And so you would fall into this bucket to where your production is based on how much margin are we producing. Now, if we're looking on the back end, management labor. This is the people who aren't directly revenue producing. This is your marketing department. This is your bookkeepers. This is your accountants, your financial analyst, CEO, CFO. All those titles would fall under management labor. They're measured slightly differently. So we measure management labor on how much contribution margin are we able to produce as a company in relation to how much management labor we are paying out. That's because our goal, the goal of the management labor bucket is to, one, make sure that we are managing our costs and our people in an effective and efficient manner. So we're getting a good bang for our buck. We're getting a good return. And so we measure them on what's called management LER. So a little bit different way of measuring it compared to direct labor, but it's equally as important, because in order to have profitability, in order to hit our LER targets, we need to have both of these ratios in alignment. Now, at the end of the day, no matter where we spend the dollar, whether it's on an in the field, on the production line person, whether it's in an accountant, whatever it is, we need to make sure that as a company, we're still producing that magical number of $2 of margin for every dollar of labor that we pay out, regardless of who we pay it to. And you can see from this progression, the company we're looking at today has had some challenges in maintaining an LER that's over that 2.0 number. That's not unusual. We see that happen quite frequently, because anytime you start getting too outside the bounds of the market, some force is going to bring you back down to earth. Now, these guys are in a little bit different position. We'll talk about why. But as you can see, 2 years ago, they were getting $3.10 of margin for every labor dollar they paid out. 2022, it got a little bit worse. 2023, it got a lot worse. But they're still kind of within that bounds of, hey, we need to be at $2. So what could be causing these guys to not necessarily be at the profit targets we want to see, which, if you'll remember from our last webinar, we want to see you at 15% profitability as it relates to gross margin. That's kind of our target. If we can get to at a minimum 10%, that's good. We really need to be at 15 and above. So I'll pause there. Michael, any questions come in? We can answer right off the bat.
One question, I think, just for clarification's sake throughout this. So is sales staff considered part of the management in that specific line?
Yeah, most of the time we're going to put sales labor into your management labor bucket, with one exception. If they are 100% commission based, we will look at putting them above what we call kind of above the line into direct labor, because they really just become a component cost of that production. Most of the time, that's not the case. They have a base with some form of commission, and so we'll stick them in management labor. There are rare occasions we make some model customizations, and we'll actually break sales labor out separately from either of the labor buckets if it's a sales heavy intensive organization or industry. Now, most small businesses, you might have 1 or 2 or 3 salespeople. You don't have a team of 20, 30 where the numbers start making sense to break out. So for the most part, I would say let's stick it into management labor and not worry too much about it. Good question though. All right, so we kind of covered what is in our labor buckets. We've talked about our total LAR. You know, if you remember last time from our discussion, direct LAR, we don't have individual company targets that we say, hey, you must be at this, because every company pays their people differently, charges their customers differently, and has a different cost structure. And so when you're trying to set an LAR target, there's really not a gold standard for anyone. It's more about how do we perform best as a company. And so how do you do that? Well, you look back through time at your own data, find when you're performing best in terms of profitability and everything else. And that becomes kind of your internal benchmark of how do we get closer and exceed the benchmark if we can. Now, LER can be a double-edged sword. An LER that's too low, we're not getting a good enough return. We're not going to be able to have cash flow. We're not going to be able to make money. An LER that's too high, a lot of people look at it and they say, well, that could be a good problem to have. And in the short term, the answer is it can be. In the long term, you're getting increased production over what maybe you should be. And if you think about it like an engine, you can redline the engine for a while. It'll run, but eventually you're going to have issues. Same thing happens in your business. When you push your labor to a point over and above their actual productive capability, they might perform well for short spurts of time, but eventually it's going to break. People are going to burn out. We're going to have turnover. Turnover kills your LER because then you spend time rehiring, retraining, trying to get someone up to the capacity that your existing workforce was at. And so we look at LER as one of those, especially direct LER, as one of those metrics where we always want to be sort of chasing our tail in the fact that if we have an ideal LER number, we want to make sure that we push our production up close to that ideal number. And as we keep growing, sometimes we do add labor on before all of the growth is recognized. And so if we're adding labor without the resulting margin yet, we are going to see the metrics come down, but that's okay. That's a planned decrease with a plan to keep the growth flowing, and we're going to grow back to where we were. And the cycle repeats over again. So let's start looking at kind of what do we see going on across these 3 years in this company's life cycle. And I can add some color. Like I said, I do work with these guys, so I know some of the things internally that happen. And if we look back in 21, we're coming off the pandemic. Things are getting a little bit better. People are feeling good. Employment's high. Wages are going up. Everything kind of feels right for everyone. Business is booming across the board. And you can see from their results, they had a phenomenal 2021. Record profitability, breaking almost 10 million in top line revenue, really solid margins, great LER numbers just across the board. Fast forward into 22, and this is when some of the cracks in our economy started showing. If you remember back then, just 2 years ago, supply chain issues were becoming pretty hard. Wages kept going up. The availability of labor was just not there. There were more job openings than there were people looking for jobs. And so all of a sudden, we're looking at, I think this was probably midway through Q2 of 22, I had this company come to me and they say, hey, something just doesn't feel right. We're losing cash. Sales still look good. We're not profitable as we were. I don't understand what's going on. And so we start unpacking it and looking to see, hey, what could be going wrong and what should be a banner year. And if you remember, the supply chain issues were also coupled with rising inflation costs. And so what I told these guys to do, I said, hey, we need to go look at our 10 most profitable products, and we need to see how much of our actual cost impacted our cost of goods. Because if we thought the costs were $100 an item, and they've really increased to $125, $130 an item, we're losing out on margin for every sale we make. Lo and behold, after they go through this exercise, took a couple of weeks. That was the problem. Their cost had risen almost 50% on some of their most popular high volume items. And so they had not adjusted their pricing to account for this. So every time they were making that sale, when they were expecting a margin that was 50 or 60%, they were really getting a margin that was almost half that. And so that started taking a real hammer on their profitability. Along that same time, if you'll remember, wages started rising, and they rose very rapidly. And these guys were no strangers to it. It happened to them too. And so they had their pass-through costs going up, they had their labor costs going up, and they're sitting here going, I don't know what to do. Well, in this situation, you have to start breaking it down and saying, hey, how do we address the problems that are facing us as a business? Well, let's break it down into our two kind of components of what we call the business engine. So from contribution margin up, we call this the business engine. And when we think about the engine, what do we want engines to do? We want them to run efficiently, and we want them to run effectively and produce a lot of output. So how do we make our business engine effective and powerful? Well, our first lever that we look at is our gross margin. So how much of that top line revenue do I get to keep? Because if you remember from last time, we look at gross margin as the real top line of your business, because we don't get to choose what to do with all this revenue. Just like these guys, they don't get to choose what to do with the $10 million of revenue they're making, because a good portion of it already has a name when it comes in the door, and that's called inventory. So what can we do to impact our gross margin? Well, number one, we look at our pricing. So going back to 22, these guys haven't raised prices in 2 or 3 years. And all of a sudden, they're facing rapidly increasing costs that they need to go back and try to recapture some of those increases in the form of price increases. You can do that too. You raise your prices, costs stay the same, automatic boost to margin. It's not always that easy. If you've ever dealt with customers, you know nobody likes being told, hey, you're getting the exact same thing, but it's going to cost 10% more. I will say over the last 3 years, you probably had more receptibility to price increases, at least in our experience, than you have in the past. And that's coming to an end a little bit. I think from our understanding of what our clients are facing, there's a little bit of pushback now. But if you think back to 2 years ago, it was normal. I'm sure every one of you got an email from a vendor, hey, effective June 1st, your costs are going up to X dollars. Hey, effective January 1, we're raising prices again. It was a never-ending cycle that seemed to keep happening, because that is probably your most effective lever of impacting your revenue. Now, if we increase our prices, what can we also do? Well, we can look through our vendors. We can go back and say, hey, can I use a different vendor that can make this a little bit cheaper? Or can I use different components within this manufacturing operation that don't necessarily cost as much? So if we lower our costs in that manner, we don't even have to change prices, and maybe we get some margin back there. Oftentimes, though, it's a combination of those two approaches that really lets you impact your gross margin and the percent we get to keep. So maybe we're down 20%, and so we look at it and say, hey, I know we can raise our prices 15% and nobody's going to flinch. How do we get that other 5? Well, it's probably about looking through and making sure that, are we being efficient with the sourcing? Are we being effective with our spend decisions in the products we're making? And so those are 2 ways we can directly impact gross margin. The other thing to look at that doesn't necessarily involve pricing or changing vendors is, what are the things that we are selling? So as a retail company, sometimes you have a ton of SKUs. It's really hard to keep track of all the different things you sell, and everything you sell doesn't have the same margin. And so doing an analysis on all the different SKUs that you sell and understanding what is the return I'm getting for the input I'm having to have. And by that, I mean, across time, pick a time period, say, look at 23. For every SKU, you should look at how much gross margin per SKU did I make against what was my average inventory I kept on that item. And then you rank them, because what you will end up with is basically I had $100,000 of margin on a product, and I only had to keep $1,000 of inventory on average. Fantastic. You're probably also going to find the inverse true of I only made $1,000 of margin on this item, but I kept $100,000 of inventory. And so optimizing what you're stocking and what you're selling for the relative margin you get in the return on it can really impact this gross margin number. And I would argue if you're a retail company, this is critical. You have to be looking at this stuff, especially in light of all the cost increases, changes in consumer behavior, and all the other changes that we've experienced really since COVID. All right, any questions on any of that, Michael?
Yep, I think one here, not sure if you got to it exactly, but does direct labor include all related costs? So specifically, Michael Arndt is wondering, within payroll, benefits, et cetera, is that rolling into direct labor, or as you see, is it more so within the operating expenses? What's the difference or the breakout there?
Got it. Great question. Great question. So it does not include all of the taxes or benefits, and there's a couple of reasons for that. Number one, not everybody has the same tax rates. Not everybody has the same benefit structure. And so I'll give you a real world example. I work with two different tree care companies. One of them is a very generous company that covers 100% of the health insurance costs for their employees. It's a great benefit. A lot of companies wouldn't even consider this. I have another company that they cover a portion of it, but a very small portion. And so if we tried to evaluate those two companies on the basis of how productive their direct labor is, if we put the company's benefits in the direct labor that paid 100%, we would have very skewed data because their cost structure and their choices as a business are very different. And so our direct labor, we always want to be looking at strictly your labor dollars, so your wage dollars, not your benefit dollars. Your payroll taxes and benefits are going to live in this line down here in your operating section. It's important to know, but when we're trying to measure actual labor productivity, we want to know for the dollars we're choosing to pay this person, what's the production we're getting? Now, the net difference is going to come out here in our net operating income. So we're going to see the impact, but in terms of how do we measure their actual production, we want to make sure this is strictly your wages paid. All right, so we got that answered. Well, let's talk about direct labor. We'll stay on this train and talk about what do we do here and what do we see. So across time, if we're watching this, the labor efficiency took a little bit of a dip here, but we got really efficient when we rolled forward into 23. And this is probably one of those where you pause and you have to think a little bit and say, what exactly happened? Because if we look at the story from 21 to 22, we lost a couple of points of efficiency. We really didn't see any growth in the gross margin. We saw a little bit of growth in that labor. And so I would tell you this 21 to 22 is more of a story of improper pricing, didn't keep up with our cost increases and rising wages. So for all intents and purposes, yeah, we grew revenue year over year. Because we did not account for those changes in our cost structure, we lost out on significant points of margin from 21 to 22. We also got whammied by rising wages. And so our efficiency is down a pretty good bit, all on the back of that. Now, fast forward, and if we're looking at the difference in 22 and 23, we can see our labor dollars went dramatically down. We look like we have great efficiency. We lost a couple of points of margin, not a lot, but this is more of a structural shift in how we made the products with this particular company. So yes, we have a slightly lower margin, as you can see here, but it was an intentional choice in that we raised prices. We outsourced some of the manufacturing, not doing it so much internally, but we let other people do it. So we were able to dramatically reduce our overall internal labor cost while only losing out on less than a point of margin. In fact, if we follow this line right here, which is measuring how much of the contribution margin are we keeping as it relates to revenue and as it relates to gross margin. You can see we're actually 4% better on average year over year than we were here, and we're doing a lower volume. And that's purely because we made better decisions on vendors, manufacturing, and the overall labor force that we had as a company. So in general, if we're looking at, declining LERs, changing LERs, we really need to understand what is that happening. If we see an increase in here, obviously we're getting more margin for the dollars, but on the downside, if we see it going down, what are our next steps as a company? What do we do? So, for example, if we simply look at the decline from 21 to 22, we have a couple of different options that we could have addressed it. Number one, we could have cut our labor. So bring our labor down, don't have as many dollars because our production up here is down a little bit. That would have helped our efficiencies. Number two, going back to how do we affect margin, we raised our prices to account for some of those increasing costs. That would have raised our margin percentage, made us a little more efficient. The last option is also not I think it's the least fun one. It's get different labor. Sometimes there's a bell curve for when you're looking at employees and their production relative to their value of your company. And oftentimes you'll have people who may be long tenured, they've reached the downward end of the bell curve. And sometimes it's easier, better, however you want to look at it, to cycle them out, find new employees, find new blood to bring in, reset comp expectations, and that can help improve LER as a whole. So from there, we can start looking at our management labor. And so management labor, if you remember, their job is to grow, manage, and make efficient our business engine, our contribution margin. And so they can do this in a variety of ways. They can make sure that we are selecting the right vendors. You can make sure that our production plans are in alignment with what the customer wants and needs. They can make sure that we are staffed appropriately and that, hey, we have enough people to keep running. We're not overstaffed. We're assigned correctly. And so we measure them, again, on the basis of how many contribution margin dollars do we produce for all the management labor that we pay out. Now, this does have a target range that we give for it. Like I said, direct LER, we don't. Management LER, we've seen across all the clients we work with, every industry, doesn't really matter. We want to see this number at a 3.5 to a 4.5. That means we're getting $4 on average of contribution margin for every management labor dollar that we pay out. In our experience, this is a good ratio and a range that ensures we're getting bang for our buck as a company, and that, hey, if I've got a $65,000 a year admin assistant, I could fully utilize her time. I have 40 hours a week. She stays busy. She provides value to me as a company. On the other side, we're not running them ragged. A lot of people want to try to push that management LER as much as they can. And for a while, it does work. But go back to what we talked about. There's diminishing returns, and there's a limit to how far you can push people. How productive can they be over the long haul? And so from our experience, on average, we need to see your management LER settle in around a 3.5 to a 4.5. Now, I will say it is very challenging for most small businesses to achieve those numbers if they're in growth mode. And it goes back to what we talked about. A lot of times you're going to be hiring in advance of some of the growth. So if you're a company that's looking at, hey, I want to get from 3 to 5 million, and you're trying to map out what does it take to get us to that 5 million number, sometimes it's a director of operations, it's a director of business development, a high title, high salary position that will allow us to eventually get to the goal we want to be at. And sometimes we have to take that hit to the P&L, take the hit to the LER in order to bring us up to where we want to be long term. And so if you're in this boat and you're looking at your metrics and you think, man, Marcus said 3.5 to 4.5, I'm at a 2.5. That's okay. We have a ton of clients that are there. The key is we can't stay there. We have to maintain, if we make a strategic hire to get us to a point where we want to be, we have to keep making progress towards that. Runways are pretty short when we run out of cash. So accept that sometimes we can't be in that range, but know that over a long term, a stable, profitable company, that's the target you really want to be at.
Marcus, we have a couple questions here that I think will be helpful. So a couple from Michael Arendt here. So one in terms of, I think this is more related to what we were just covering here. So 3.5 to 4 in terms of the LER to contribution margin. Is contribution margin coming after direct labor there?
Yes. So calculation for contribution margin, we have revenue minus cost of goods gets us gross margin. Gross margin minus direct labor gets us to contribution margin. If you're familiar with financials, most financials are going to call this gross profit.
Great. Okay. Perfect. And then this one I wanted to say secondly here, a bit more conceptual. So also for Michael, I'll read this question out. I want to increase PTO and company benefit contribution in efforts to reduce turnover. How should I model this out?
So you want to provide additional benefits to your employees in order to provide retention, increase production. That's all great. What will essentially happen with this is your payroll taxes and benefits will increase as a relative percentage of your labor. And so when we're modeling it out, I would just forecast, hey, what on average are we looking to increase that PTO bucket by? How does that impact overall profitability? I would be hesitant to forecast in any improvements in your efficiency of labor because in our experience, while it is a benefit, it's not necessarily one that provides increased impact. And so I would look at it more through the lens of, can we afford this increase at our current run rate? And maybe we get some upside. I would not depend on any upside to make that decision for you, though. Was there any other questions there, Michael?
No, that answered that one. Great, thank you. That was also very helpful for me, who's not had this accounting mind, so appreciate it. That's it so far. We're good to continue on here.
Okay.
I think, sorry, I think we had one more question on why did the gross margin decrease from 21 to 22 from Brian?
From 21 to 22.
Yes.
So yeah, so gross margin here, basically in this company, their vendors raised prices and the company did not raise prices to their customers. So they, for example, one of their most popular items, their cost on it were about $100 an item. And when they went through and did a cost analysis, their actual cost from 21 to 22 had risen to about $125 to $130 an item. And they, in that time period, did not raise their prices to customers. And so they're still charging their customers the old price, but they're keeping less of those dollars because their pass-through costs have went up. And so that really pushed margins down for them in 22. That caused them to rethink some of their sourcing decisions.
Okay, perfect. I think those were all the questions so far.
All right. Cool. So covered our ratios for management labor. I will say one of the things that we do at Simple Numbers is we take 100 different companies that we work with. We take all of their data, which is in this format. So one of the benefits of being in the format, we can aggregate data and compare a $1 million company and a $20 million company across various industries, regions, whatever, and we can start getting our own economic outlook. And one big trend that we're seeing right now is management labor is really, really inflexible at the moment for most businesses. So everybody's doing a pretty good job of expanding and contracting their labor client-facing workforce to the demands that they need. So as they expand, they've expanded it. As it's contracted, they have contracted those direct labor dollars. Where businesses are not seeing any flexibility is in that management labor bucket. And so this is really a couple of different reasons. Number one, people are hard to find. And so if they've invested the time and effort and energy, not to mention dollars, into finding these people, they're really hoping that things turn around. And so this picture that we're seeing here is a prime example of that. We have a company that is losing out on contribution margin. They're not seeing growth up here. They've done a fairly good job of right-sizing their labor. They've made some strategic decisions on their cost of goods, but at the end of the day, they've improved how much of the gross profit they're keeping, the contribution margin they're keeping on a year over year. The same cannot be said of their management labor pool. And they are not they are the rule, not the exception. This is a pervasive trend that we keep encountering, that people just aren't willing to make the hard decisions and give up. And they're doing a strategy we call buying hope. And if Greg were on here, he would tell you hope is expensive right now. Hope is keeping that director of operations on staff who hasn't been effective year over year and just hoping that maybe things turn around. Hope is keeping the sales force on staff who maybe they haven't sold what they need to do, maybe they haven't hit targets, but we're just hoping that sometime things will turn around, they're magically going to produce better. It's a tough economic time right now. And so looking at the numbers, understanding what they're telling you, and then making decisions off of it is really critical if you want to be in business in a year, in 6 months, in 18 months, whatever your time frame is. Management labor has to be held accountable for the contribution margin produced. And if we start seeing changes in it, it has to flex with the rest of your business. The rest of your costs, for the most part, are going to flex with it. But management labor is one that we really have to keep a watch on, because if we are looking at this company right now, we can see, hey, we went from good to not so good to now we're downright bad. If you follow the total LER of the company, it also follows the decline in profitability overall, and that, hey, we're getting less and less bang for our buck as it relates to what we're producing. And so making sure that we keep these costs in check, know what we're encountering, is critical. So if we're looking at kind of what makes these changes, what do we need to do? If we're looking at this company year over year, they're what we call, hey, they're declining in revenue. And so when we're in a decline in revenue, we need to see, number one, is it revenue and margin declining equally? Number two, are they out of balance? So is revenue declining and margins declining at a higher rate or a lower rate? And we need to understand the difference in these two. As we can see here, it's kind of a increase in revenue, decrease in margin. Well, now we're declining in both. And so this is a prime candidate for, hey, we really need to pull the emergency switch and figure out, how do we right size the company? What do we need to do to get us back into a profitable position? For these guys, the answer not only is getting our labor right sized, it's also examining what is the return we're getting on some of our expenditures. And their second highest expenditure next to labor is marketing. A lot of you guys I know invest heavily in marketing, and I say invest because we at Simple Numbers, we look at marketing as an investment in the future of your business. And just like if we're investing in the stock market, you don't buy $100 of Apple stock hoping that it's worth $100 in 12 months. You buy $100 and you hope it's worth $200, $300, $400 as the time goes on. Marketing needs to be viewed the exact same way, because this is a bet that if I invest $800,000 in marketing in a year, I know I should get at least $1.2 million of additional revenue generated from that. Now, why is that? Well, one, we want to get our $800,000 back, but we also need to get a minimum of a 50% return on that investment to justify making it. As you can see, we're not quite here with this company. The marketing investment increased year over year for an actual decrease in some of our production. From what we can see, this is a similar story that a lot of you guys out there are facing right now. And I would encourage you to take a really hard look at some of the marketing strategies you're employing, some of the paid advertising and things you're doing, and really evaluating are we getting the best bang for our buck that we can? Because if we're not, we're just decreasing profitability. We're spending dollars to spend dollars. We have a couple different ways we look at this. We don't have them all in this model. It's a little more complicated. But in general, I will tell you, you need to hold your marketing spend accountable. And that is one thing, we're looking at the end of 23. In 24, working with these guys, they made significant changes to a lot of their marketing that they used to do. So they were heavy affiliate based. That really, with an algorithm change from YouTube and Google, dried up. You can experience the same thing if you're a very digital reliant marketer. And so really looking through and deciding, is this $2,000 a month I'm paying for Google ads effective? Is it getting a good return? It's something you have to do right now because your costs for the ads, your customer acquisition costs are higher than ever. Michael, were you going to say something?
Yeah, perfect. So want to hop in there. So Real has a couple of questions here.
Okay.
So in 2023, the management labor increased, but the sales decrease in involves fewer direct labor. So is this something that would need to be addressed moving forward? And then once we answer that, I'll dive into the next question there.
No, 100% that is definitely an issue that needs to be explored. I will say that the increase in management labor for this particular company was mainly wage increases and not necessarily headcount increases. And so there was another thing of rising costs that they weren't necessarily able to recoup through price increases, but they also had a sheer drop in volume. So, spoiling it into 24 a little bit, they did address it. They've had made some moves, but no, definitely it's something you want to look at and take action on.
And I think, within that, I think just understanding the overall numbers here. So Real also follows up. So in the deal in 2023 decreased almost half of the 2022 figures, but the taxes and benefits remain the same. So what would you analyze that to essentially mean, and how would that maybe indicate one action one way or the other?
Yeah, I mean, you have to break down and see what is the variable component of that payroll taxes and benefits. And by that, it's primarily going to be your FICA cost. And what's the not so variable cost in that maybe we switched benefits, maybe we had insurance rates go way up, maybe something along those lines. You really have to understand what would all make up part of this. I don't remember exactly what the reasoning was between these two as what caused it. But it's one you would try to break it apart in what's my 7.65% that should be FICA, and then what's everything else? Because I will say, on average, the clients we work with, 15 to 20% increases in your health insurance premiums year over year has become pretty normal, and there's not a lot of relief. So I would imagine this is probably a similar story. Does that answer all the questions, Michael?
Perfect. And Jordan popped in here with one other one. So managers up 200K and direct labor is down to 300K. Health insurance would probably be the rest.
Could be. We really have to look at it and see what's the difference. There could be some other benefits that you roped in there, workers' comp, some things like that. It could be in there, but we'd have to look at the underlying data and do an analysis to really understand.
Great.
All right, so I think we've covered a lot of the P&L type stuff that I wanted to make sure we get to. Kind of gave you a little taste of what we're looking at when it comes to the 100 company model in regards to management labor. On the other side of it, I wanted to touch on some of the balance sheet stuff that we got to a little bit on the last webinar, but didn't quite have enough time to really break down and talk through some of the concepts. Again, if you have questions, let's throw them in there. We want to make sure that you're getting the value out of it. We're going to be looking right here at the 2022, because that's mainly what our other data covered. We'll go back and talk about trade capital. We covered it, I think, pretty in depth last time. And so trade capital is basically how much are we financing our customers through inventory or accounts receivable versus how well are we getting finance from our customers and vendors through accounts payable, deposits, credit cards, things like that. And so it's similar to working capital, except we're not counting how much cash that you have, because we want to know, what are we looking at in terms of growth. So, and by that I mean, if we want to grow 7%, or if we want to grow $1 million, 7% of that we're going to need as trade capital, because our trade capital as a percent of revenue at this point in time was running 7.96%. Now, good news is we were profiting over and above that at 10.7%. So that was good. You fast forward and look at a year-over-year change, and the numbers are not quite as attractive. We look at 23, we saw a significant decline in what our trade capital as a percent of our revenue was running, but we also had a significant decline in our net income. And so this can lead us to a scenario where a year ago, growth was basically cash free for these guys, because they needed 8% additional trade capital for growth. So that's on $1 million, 8% of that. But we were profiting at an excess of almost 11%. So that 3% differential would mean the cash we need to grow was exceeded by the cash we received from growing in the form of sales. If we look here at the end of 23, we've basically closed that gap completely because our profitability has declined so much. And so when we're looking at this lets us know it's going to be a precarious position. If we grow $1 million, we're not really going to generate any additional cash on that growth. And so we're going to be funding any growth that we have with the current profits that we're making. And understanding that about your business is critically important. If you're a heavy inventory-based business, it's going to be very hard for you to have a positive, or to have a negative trade capital, because we're typically going to have inventory and accounts receivable that are in excess of any payables we might have. Now, these guys do a pretty good job of utilizing terms from their vendors. They do a good job of getting paid before some of their products is necessarily ready to ship. So they have some what we call deferred revenue, which you might think of as customer deposits, things like that. So they do a pretty good job of using other people's money to fund some of their operations. It's a great strategy that can work. We just got to make sure we don't end up upside down on it. The other thing that we want to look at is our core capital target and how important it is. And I'll give you a little anecdote right now. So in our 100 company model, year over year, cash balances are up 0%. So they are flat year over year. Line of credit balances are up approximately 57%. So companies are increasingly using their line of credit to fund their working capital needs because they cannot generate the cash. And so when we start looking at our core capital target, it really becomes critical to know, how much do I need to keep on hand to keep the lights on, the people working, and all the vendors paid up so that we can keep working. Because if cash is flat and we're in debt more than ever, that's not a good sign for cash flow. The other thing I would encourage you to go back and look at is, what is your change in your average day sales outstanding? Because what we're seeing is, on average, 15 to 20% increases in those day sales outstanding, which is directly impacting how quickly do you get paid and how quickly do you convert that to cash. And so if your cash is already in a crunch and we're getting paid on a longer time horizon, it can lead to very bad outcomes that you want to avoid. Meeting this core capital target is one way to help avoid that. So going back to our last webinar, core capital is how much cash we have on hand, less whatever we have drawn on a line of credit. That's our net core capital. Our core capital target is we want to be at 2 months of OPEX plus 2 months of direct labor. And sometimes it's a kind of a rolling average. If you have peaks and valleys in your demand cycles, sometimes your core capital target might be 500,000, and in an off season it might be 250,000. So you really have to understand that at any one point in time in your business, what do we need to have? And this calculation here will lead you to a good answer, but just know it's not a static answer. So as we grow, as we shrink, As we get busier, as we get slower, it's going to be an ever-changing number. So if I need $250,000 today, if I have 100% growth as a business, it's not going to be $250,000. And so this model can really help you hone in on what is a smart cash number that we need to keep inside the business so that we can keep operating.
Marcus, this is, I think, a good question to bring in here. So Zachary is asking, is a forecast component being built into this, or would you forecast this separately?
Yeah, so that is one component that Alisha and I actually are going to get together and work on in our kind of full version Excel-based model that we use. There is a forecasting component where the balance sheet and cash flow are integrated. And so it really helps forecast your core capital needs across time. You know, this is kind of our version 1.0 of the LiveFlow template, but we are looking to expand it, refine it, make it much more useful to you. And hopefully in the future, maybe not too long, we can have another webinar where we can talk about, hey, here's the version 2.0 and how that kind of relates to you as a business. So good question.
Yep, just to add to that, we'll be working on building out the forecasting component, and we'll send an email out to everybody who's downloaded this one, so you can just quickly and easily swap over to the new one that has forecasting as soon as it's out.
Yeah. So final thing, wrapping up today, it lines up perfectly with the forecasting, and I'll just give you some high-level thoughts on how we look at doing a monthly forecast. A lot of people get hung up on wanting to, you know, look at 12 months in time, longer time periods, and sometimes that's great if we're looking at it overall. When you start trying to forecast by month, though, we really encourage you to go with what we know. And by that, I mean, most business owners that I work with, that we work with on a day in, day out basis, they have a fairly good sense of, well, what does next month look like? And maybe the next month based on what they have in their pipeline, what jobs they have going on, things like that. And so we really encourage people to forecast each month for the next 2 or 3, depending on how comfortable you are with your sales forecast. And in general, if you can help know what do I think roughly my sales are going to be in August and September, that can really inform the rest of your P&L, because we can go primarily by historic, and if there's exceptions, you can add it in. So for example, if you know you typically run 60% margins, and you know, hey, over the next 3 months, I'm going to sell 500,000, 450, and 600,000. Apply that same margin number to each month, and you're going to know how much gross margin you produced. You're going to know with relative certainty how much labor you pay out, because you know who's on payroll. What are the average hours they're working? Are we running overtime? From there, you can start breaking apart your overhead. Facilities cost. Everybody knows what their rent is. You can roughly guess what your utilities are going to be, things like that. You know about what you spend in marketing. You know what your management labor is. They're on your payroll. Pull a payroll report. Look at what your monthly cost is. Plug that number in. Payroll taxes and benefits. Typically, we just use a percentage. So on average, if your payroll taxes and benefits are 15% of your total labor, you can make an Excel formula. 15% times your direct labor plus your management labor. That'll help you forecast out that portion. Other OpEx is one of those nebulous ones that sometimes it's a little harder to dial in. And so we tend to look at some, 3 and 6 month averages. If we have a insurance renewal that hits, we want to make sure we're adjusting for that in any month, because it might really spike those expenses. But forecasting in this simple numbers format is really simple. It's the hallmark of, probably half of our monthly calls we do with our clients, and figuring out, what do we think the next quarter looks like? How does that impact our cash flow? How does that impact, our trade capital needs, things like that. So we will be expanding the template, like I said, to try to encapsulate a lot of that stuff. If you have more questions, reach out. Michael, anything else before we wrap up today? I know we're almost at time.
No, I think that's everything. If you don't have any more questions from the audience, please let us know if we can get anything else answered before we log off here. But I think that's everything. Marcus, Alisha, if there's nothing else from your end, I can wrap it up from here.
Well, I appreciate everybody joining today. Like I said, happy to answer any questions you might have after the fact. Simple Numbers, CRI.com. You can reach out and talk to us if you need to. I really encourage you to try out the template. I think it's super useful. For context, I built this model in about 30 minutes, so it's very user friendly.
Yeah, that's great to hear. And yeah, if you have any questions around the template itself, or if you want to make any modifications to it for your specific use case, then please do reach out to me at, I think you can just reach out to me directly at alisha@liveflow.io, or you can contact us through our demo links and somebody will put you in touch with me.
Yep, and to follow up on that, yeah, I will be sending out the recording after this call with Alisha's email, Marcus's email, links to the template, links to just learn more about the template and CRI and LiveFlow in general. So keep an eye out for that so you can make sure that you can access all of these resources. But yeah, like Marcus and Alisha said, really excited that everyone could join us for this session today. Really looking forward to version 2.0, as Marcus was alluding to here, and the next webinar session that we'll have covering that specifically. So we're excited for it.
Thanks, guys.
Great.
Oh, I think there's
Thanks.
one last question on the two models. Michael, one of them is the Cashflow template is for Google Sheets, and I believe we call the Excel one model just to distinguish it on the website. But yeah, the first one of them is for Google Sheets and one of them is for Excel, depending on what you're more comfortable using.
Mm-hmm.
Yeah. Okay. Thank you.
Awesome. Well, thanks everybody. We'll leave it there. Yeah, really excited to see everybody at the next session. Have a great rest of your day, everybody.
Bye-bye.